The first slide I want to show is this is the Green Street Commercial Property Price Index, core real estate, retail, office, industrial, and multifamily. And that's basically leveled off for the past 4 or 5 years in terms of pricing, up 2%. But the thing is it's really different because retail has been down quite a bit, and the rest of the sectors are up. So ex retail, it's 4% or something like 4 or 5% a year appreciation, not 2. Next is commercial construction has leveled off. It doubled off to 2010. And this is office, industrial, retail. And, went from like 70 billion to 140 billion, and it's been basically leveling off. Next is the good. We heard about industrial is definitely good. Apartments are also good. Low vacancy rates and rising rents. Apartment rents going up 3.5% to 4%. These are national numbers. Industrial rents 6 to 8. California is better. The bad is office. California is better in office than the rest of the country. And there's also huge structural obsolescence in office buildings. And I think one of our panel members will discuss that issue. Huge structural obsolescence. So even though there's high vacancy, we're going to get a lot of construction because of the obsolescence. The ugly is retail. And the 3 most dangerous words are one-day delivery for retail coming from Amazon. That's the 3 most dangerous words for regular retail. This is the national apartment vacancy rate. Peaked at 8%, dropped to 4%, going up a little bit, but still very, very, very good. Rents are rising. This is the CPI for rents, tenant-paid rents. It's been over 3.5% basically for 4 or 5 years, higher than wages, and that's part of the problem. In California, rents are up, call that double, Paul, double. Rents going up 7% in California recently? Not now, really. But previous years. Okay. This is office vacancy rates. Really haven't come down nationally. In California, they have because of the better economy, but office vacancy rates are still very high nationally. This is retail vacancy. They're back at recession levels. And this is when times are good. So if we get Ed's recession or my mild slowdown, these numbers are going to make new highs. Since 1980 on retail vacancy. And we have store closing announcements happen every day. This is the share of e-commerce from 2000 to the end of last year. E-commerce has gone from essentially less than 1% to 10% of retail. But if you back out automobiles, which you can't do e-commerce, gasoline, which you can't do e-commerce, and restaurants, food services, e-commerce is 17% of the retail market. Reason why you see so many more food halls and food courts and malls is there's no e-commerce competition for that. That's why you're getting a shift. And then if you take a look at the growth in this addressable market, which is total retail, less the autos, less the gasoline, and less the food service, e-commerce account for roughly half the growth. So the thing is when people used to do pro formas, they used to just look at retail sales growth and mark that up. But if you have half your growth being taken away from you by e-commerce, you've got a real problem with basic retail. And this share is growing over time. So that's my background. Now introduce the panel. Okay, on my immediate left, we have Mike Copen, who does leasing for McCarthy and Cook. And he's doing a major project here, not too far from here, on Olympic and Sawtelle. Correct. Olympic and Sawtelle. We have Marianne Lowenthal, who's Executive Vice President, West Coast Acquisitions and Development for Combined Properties. And she's been involved in such things as the Lincoln and Rose development. Those of you know that that shopping center area. We have Paul Habibi. And Paul is a continuing lecturer in finance and law here at law?
And real estate as well.
Real estate as well. Here at UCLA, and also has Habibi Properties, which owns multifamily apartments here in Southern California, and some agricultural interests, and some single-family homes in Kansas City, Missouri. Okay. Then we have Murray McQueen. Murray McQueen is in charge of Tribune Real Estate Holdings. And what Tribune Real Estate Holdings is the leftover printing plants at the LA Times, the Chicago Tribune, other
Bunch of legacy newspaper land
Legacy
around the
newspaper-
country, basically.
legacy newspaper land around the country. And I think he used to work with my friend, if I will have my friend David Weil.
Yeah,
He
at
used to work
DLJ.
when he was at DLJ, my good friend David Weil. So it's a very small,
The world is small.
it's a very
We all
small
know.
world. So I want to ask, my first question I want to ask to the office people, I want to ask about WeWork co-location space. WeWork and similar companies, according to JLL, Jones Lang LaSalle Real Estate, accounted for 1/3 of all the leasing in the major cities in the 18 months ended December 2018. And they account for 3.5% of all the office space in place right now in Manhattan and San Francisco, and 2% in West LA. So it's a huge chunk of the market that came just out of the blue, although we had that in 2000 with Regis, and then Regis went under. So my question is WeWork a friend or a foe to the office landlord? So let me start with Mike and see what he says.
I think it's a question that will probably be asked for the next portion of this cycle. They have, of the 12.5 million square feet of expansion that's occurred during this cycle, 30% of that here in LA has been through co-working. And I think they've, on the upside, have taught the industry quite a bit. The fundamentals have shifted in terms of how we look at workspace, and the short-term, zero capital nature of the occupants that occupy those spaces are certainly changing the fundamentals of the leasing world. And now with the accounting shift of FASB, they're confident that a lot of these occupants...
But why don't you define that for the audience?
Yeah, so that lease obligations and equipment will no longer be allowed to be on the income statements. It'll be a part of the balance sheet. So that, they believe, is going to force a lot of enterprise, what they consider as anything above 1,000 employees, enterprise members, they call them members or subtenants, to further up their concentration in shared flexible office facilities. And so they believe that demand will continue despite the downturn risk. Obviously, there's balance sheet risks, profitability, cash flow, things of that nature that we certainly think at some point during a downturn.
They lost $2 billion last year.
Right, right. And at some point, during a downturn, it becomes a zero-sum game. If you're a landlord, you ask the question, what is the other landlord across the street doing? When a downturn occurs, you're going to be asking, what's the guy on the third floor doing? And I think that becomes problematic. But I do think there's some hedge that we're seeing from these groups that are diversifying some of their operational formats in management assignments as opposed to just taking on long-term leases. They're working with the landlord so they can share in the upside. So there are some diversifications. They're now raising money to buy buildings. So we hope that continues.
That's no longer asset light.
That's right.
Yeah.
Murray, do you have any comment on their business model?
Well, I think that the model, the co-working model, is here to stay in many shapes and forms. I know WeWork started off as working as entrepreneurs, and now a huge percentage of their growth is now large corporate tenants who want flex space.
Yeah, 30%.
Yeah, and so other people, JLL, CBRE, are moving into that space because they're dominant in property management already. And so I think it's here to stay. It's going to keep evolving. I think, as we've talked about before, I think the valuation on WeWork remains to be seen how real that is.
20 billion, something like that.
47.
47 billion?
Yeah.
Sam Zell spoke to the Ziman Center a while back, and he had some choice words that I will not repeat
You can't, we'll all get in
about WeWork
trouble
and what's going to
when we
happen
repeat
there.
what Sam
Yeah.
says.
But so.
Okay, Marianne, do you have any?
Yeah, I'm not really in the office market now, but I used to be, and I think a couple of things with WeWorks is, one on the good side, right? They're taking sort of the credit. You now have a credit tenant where all of their subtenants don't. Well, 70% of them, I guess, don't have credit, and that's, as an office owner, right? That's always an issue. So that's on the positive side, where you can now do a lease with WeWorks, and you don't have to do a lease with all these smaller tenants directly. But they also impact office buildings from just people going up and down elevators, right? So they're very high users with a lot of people, and that, I think, creates a a big load depending on what you're trying to do with your office building.
Okay.
I think in large part, it remains to be seen as we hit a cyclical downturn. A lot of the companies that are occupants of WeWork tend to be kind of fringe companies credit-wise, as you mentioned. So I think, we'll see whether the emperor truly has clothes. When we hit a cyclical downturn, a lot of these upstart companies potentially, quit their tenancies, and we'll potentially see a downsizing of WeWork tenancies in larger buildings. But I think, to answer the initial question, I think it's gotten a lot of the office landlords pretty sharp on what they need to create in their future developments. And I think that's a plus for the overall marketplace.
I want to push back on the credit issue, because when WeWork leases in a building, sometimes they use a special purpose entity, bankruptcy remote to the parent at WeWork. So the credit may not, so if that it doesn't work in that building, they say, bye.
Yeah. No, I guess what I meant was the diversification of tenants even within a WeWork creates a little bit of more resiliency than having a single
And then
tenant.
another question I want to raise is, if we're going to shorter term, more flexible leases, which is the WeWork model, and then the regular primary landlord, the primary office landlord, may have to adjust. So instead of having these leases, 10-year leases that require 3 law firms to figure out what's in them, and you go to shorter, more flexible leases that are 2 or 3 pages long. What does that do to the credit of the office building? Anybody?
Well, just the fact that construction costs are through the roof already, it's extremely difficult to underwrite any sort of credit, whether, on just a return on those costs is almost unfeasible.
Okay. When I had my opening remarks, I said a lot of office buildings are currently obsolete for the new type of tenants and the new work style. Mike, you're doing a new development here in the West Side. Why don't you talk about what you're doing and what the theory of the case is?
Sure.
With that development.
So we've owned, the current project is called Trident Center. It's 2 what we would consider 1980s vintage high-rise towers on the west side on Olympic and just off of Sawtelle on the 405. And it was primarily built for 2 law firms that are currently there. One is vacated, one is soon to vacate.
Silverberg and the Manat.
Manat, correct. Yeah. And so those projects from a physical attributes are obsolete in today's workforce. The floor plates are 16,000 to 18,000 square feet. In today's world, you would want 30,000 to 50,000 square feet for today's workforce, not just for tech and entertainment, but others. So we are actually tearing down the curtain wall of each of the towers, sistering the buildings together through bridges, and creating the 50,000-foot large super floor plates all the way up each 10 floors of each tower. So we'll have 560,000 square feet total of creative office, if you will. We call it experiential office, which is the high demand product.
So what's the total project cost, plus or minus?
Plus or minus, we are spending close to $300 million.
Okay.
Yeah, makes sense.
On that. I want to ask Murray, you're more in the entitlement business than the development business.
Right.
And you're doing something in Orange County with the...
We did it in Orange County.
Why don't you say what you did in Orange County, then we'll talk
Okay.
about what happened in downtown LA, what you're doing.
Sure. So basically, just to back it up a little bit, Tribune owned newspapers around the country, and they had, back when newspapers were rocking and rolling, they had huge assemblages of land for printing plants in the middle of cities because they're distribution networks. And then as the newspaper business declined as a function of e-commerce,
Right.
A lot of these plants just became fallow, or they really didn't know what to do with them. And so in Orange County, for example, when I started the group in 2013, there is a vacant printing plant. It had been vacant since 2010 on a 21-acre site right on the 405 at Harbor Boulevard. Obviously a great site. And so we did an evaluation and bought an adjacent 4-acre site so that we had freeway access. And then we got the site rezoned we tripled the allowable density, got it rezoned from pure heavy industrial to mixed-use commercial industrial. And then really, the best thing about it is it's a custom-built printing plant. And so it's football fields long, 60-foot clear height, 150-foot bay depth.
Got a full team more.
Yeah, wow. So we just gutted the inside, and we're getting it ready to turn into creative office. And it's really in Orange County, there's nothing like that. Creative office might be, you put a volleyball court in front and, give it a name or something. And so we were waiting for to attract the right tenants, and someone came in with an offer we couldn't refuse, and so we sold that.
So
But it's
who's
an
your par-
example
who-
of just
who
sort of.
bought that? Who's your partner? Who bought that from you?
Well, no, we didn't. We were partnered with Kearney on that in the development, and then we sold it to Steelwave with Invesco, who were great. I mean, these guys all know what they're doing to a great
They own
degree.
the pro- and the
so
project.
they're actually building it out.
Okay.
We had a cold shell, they're turning it into warm shell. So it's an example of just taking just because something's there doesn't mean it should be there. And just because they have this zoning doesn't mean it should be the zoning.
Okay, so my follow-on, what, you sold the Times Mirror building downtown.
Right.
But you have a site next to that?
Right.
So what's going on with the site
So
next to that?
the original LA Times building we sold to the Ani Group, who I think is now the second largest owner of downtown real estate. And they'll be retaining the historic portions, and then they're going through entitlements to build high-rise residential on some of the parts that will be torn down. We retained a 2-acre site next door, and LA Metro is building a regional connector station on the site. So when we started, they were in the process of condemning our site for their regional connector, and we said, please stop, let's talk about this. And so, because they were going to take the air rights, which they didn't even need. And so we cut a deal with them where they agreed to overbuild their station. We'd let them use the land for free while they're building the subway. They're going to overbuild their station structurally so they can support a high-rise on top. And so we're processing our EIR right now for a 700,000-foot, 52-story residential high-rise.
So you own the air rights? And
Oh, yeah.
So you're going to sell the air rights to somebody?
We'll sell, once it's fully entitled, we'll sell the entitled development site over a metro station with a pre-existing parking structure.
Okay.
So that's an example. It was in the process of being condemned. So.
Nice. Marion, tell us about what you're doing in Hollywood with the House of Blues.
Yeah, in West Hollywood. So we, Combined Properties has historically been really a retail company, but over the last 10 years, we've changed into mixed use and retail, and even further, over the last few years, we've really sold off a number of our retail projects, either sold off our retail projects and bought residential, or we've converted 3 retail projects into mixed use, mostly residential. And sort of our most unique project is on the Sunset Strip in West Hollywood, the old House of Blues site, where we're building a 150-room hotel, 40 very high-end condo units. We have 5,000 square feet of digital signage, which brings in about a third of the income for the entire project. And then
So the return on cost on signage is what, 40% or something like that?
It's for this project, it's sort of hard to say what return on costs are, because it's hard to separate. Yeah, I mean, there's virtually no cost
For the sign.
for the sign,
Got it.
except for the fact you have to buy the land, sit on it for 14 years, and build a hotel. So, but and then we have about 25,000 square feet of food and beverage. We have a private club. We're building a music venue, a very small music venue, to sort of bring music back to the Sunset Strip.
So what kind of room rates are you looking for? Plus or minus?
You know, when we open next year, we'll be sort of in the $450 square.
That's perfect for you, Ed.
Dollar a night, yeah.
Okay, and what kind of condo prices?
Very high.
Very nice. Not for you, Ed.
So just to give an example, I mean, there haven't been a lot of high-end condos built in West Hollywood. Probably our most competitive project right now is the Edition Hotel that's going up on Doheny and Sunset. They have 20 condos, and they've been selling north of $3,000 a square foot.
Okay.
So these are condos that get services from the hotel as well.
Right.
They're not condo hotels. They're West
No.
Hollywood doesn't allow that, but they get all the services of the hotel.
So you have your room service and your.
Yeah, you can room service. You can, these are for people that really want to close their door. They're going to leave for a month, 3 months. They come back. We have concierge service. Anything they want will be in their condo. They can call for room service. They get to belong to a private club. So all sorts of.
Okay. What do you think, since you have a lot of experience in retail, and I showed you the numbers there, what do you think works in retail right now you're not doing ground up anymore in retail, or maybe a couple?
No, we're not really doing ground up retail.
Okay. So what do you think would work? What do you think works right now in what you own? What do you think is working?
Well, so we have always focused on grocery drug anchored centers in really well-located areas, and we've done very well on those. You know, you saw a slide earlier today on e-commerce where for grocery stores, it's only been 3% of their sales have been taken up in e-commerce. So I know that's going to rise, but still grocery stores, for the most part, are doing very well. There are still some stores that are going out of business. But so we really focus on those. In the areas where we've never really done big box, we only have, of all our centers, we only have one big box center, and that's been very difficult for us to deal with.
Where is it?
That's in Orange County.
Okay.
And there aren't tenants out there for obviously the big boxes, and even if you get away from the 75 or 100,000 square foot big box and you look at a typical retail center that might have a 20,000 or a 30,000 square foot box, there's just fewer and fewer tenants to take that space. So it's very difficult. But in the good areas, most of our centers in our portfolio, we probably have about close to 4 million square feet of retail, and we're at we're about 97% occupied. So, but we're in really well-located areas. And I think to get to where you're going to, as an example, you know, one of the big users of retail space now is more quick service food. Right. So, as an example, we had a drugstore that went out of business. We took what was maybe a 10, 12,000 square foot pad where the drugstore was, and we turned that into 4 or 5 quick serve, you know, retailers. We made it nice with seating around, and we went from, you know, maybe $15, $18 rents to $40 rents from those tenants.
Now, there's a concept in retail, and especially in grocery, is, you know, buy online, pick up in store kind of thing. But if you do that, doesn't that require a lot of CapEx in terms of either the store or the shopping center owner, basically to reconfigure a center to deal with people coming, ordering online, and then picking up, and rearranging stores, rearranging parking, and,
right.
and rearranging the whole configuration of the store, because you have to have, if people are going to pick up, it's got to be in front of the store, it's not going to be in back of the store, and it changes the whole store. Have you been dealing with that issue?
Yeah, we haven't built one of those. We haven't been intensely involved with any change in the renovation of the store that they want. However, for an example in Venice, so Whole Foods at our center at Lincoln and Rose has virtually taken all of the space in the center except for two different locations, and they're starting to do that sort of thing. So it's interesting because in 2009, when we finished building that center, it was a 48,000 square foot Whole Foods, and everybody from Whole Foods around the country really focused on that store as being the model for the store that they wanted, and now that's changing, right? So in 5 or 6 short years, they're sort of changing the configuration of that. But I haven't been specifically involved to see what that's really looking like for a new store.
Okay, Paul, rents in LA from 2010 to 2017 was like hockey stick. It was like straight up, like 7-8%, something like that a year.
We're going to in retail or in
apartments.
Apartments, yeah, apartments.
And then the last year we sort of slowed down to more like the national 3 to 4 numbers.
That's very fair to say. I think coming out of the downturn, we definitely had 6 to 7% a year. Very nice inflated numbers, especially with respect to inflation levels. And in the last year and a half, I think it's definitely tapered off. I'm seeing in the LA metro area somewhere in the neighborhood of about a 4% asking rental rate increase. On the occupancy side of things, it's been a little bit interesting. I think our vacancy rates are still hovering around the 4% range as an LA metro area, but there's a little bit of bifurcation now with the new inventory in Class A that has come online. I think in Los Angeles in 5 years we've seen approximately 40,000 multifamily units having been delivered. and about a fourth of those, give or take, have been in the downtown area. So in large part, Class A is giving more in concessions. They're suffering from a slightly higher vacancy rate, probably in the 6% range. Class B and Class C have been the recipients of better occupancy levels, probably in the 2.5–3% range. So
And rents are probably going up faster in the Bs and Cs than the As.
I think in large part they are. I mean, obviously, close to employment centers, those properties, kind of B and C, older vintages in some of the better parts of town have been faring better. But generally speaking, I think it's been stable, and we haven't seen a whole lot of movement in either direction in the last 18 months. I think there was some hesitation for new acquisitions given the potential issues with expansion of rent stabilization or rent control with Prop 10 last year. Now that that's behind us, we're still seeing some potential other threats coming online from other groups at the statewide and local levels. They've in large part been unsuccessful, but I think it's a matter of time until we see heightened pressure on figuring out some solution to affordability. And unfortunately, I think even though it's well-intentioned, I think there is potentially some expansion of rent control coming down the pike.
Yeah, the bill in the legislation is cost of living plus 7%, I think, for 3 years. I think
Yeah.
that's the bill that's moving.
Yeah.
Probably.
50,
Yeah,
What?
Senate Bill 50, yeah.
Yeah.
Not Senate Bill 50, different
it's
bill.
the different one, yeah.
Yeah, not
Okay.
50 is the density,
Yeah.
is the increased density.
Okay.
But there's a bill that's moving 7%, but the thing is, when I look at a bill like that, and you say, well, 7% cap plus cost of living, that's call it 9%, well, most everybody could live with that when you're only getting 3 or 4 right now. But the thing is when you see a bill like that, it's very easy to do an amendment.
Right.
It's a one-line amendment. What you do, delete 7, change to 2. And so it's very easy, since the principle is established, is you have a 7 number, like Oregon has the 7% statewide number as well. So it's very easy for a future legislature to put in a one sentence, it's a one number amendment
Sure.
to the bill, and the government code gets changed 7 to 2, and all of a sudden you have a real rent control constraint. Is that?
I agree with that. I mean, if you remember about 9 years ago or so back, we had a potential moratorium from City Council to put a freeze on rent increases in rent-stabilized properties.
Yeah.
Fortunately, that failed, but that would have set a precedent as well, because it's a very natural inclination to want to extend these temporary initiatives. And that said, I think rent stabilization doesn't concern me as much as a landlord as does vacancy control,
Right.
because at that point you're really left with, for those of you who are unfamiliar, it's where the rent control follows the unit rather than the tenant. Now, as it is, at least in Los Angeles, a tenant leaves, you can mark to market, but in absence of that, it would really disincentivize investment, discourage mobility, and create a lot of,
Do you do any ground-up development?
Yeah, actually, our latest couple of projects are some condos in West Hollywood, so I'm delighted to hear that you're going to be fetching $3,000 a foot.
Okay.
If I can get half that, I'll be pretty happy.
You don't have a hotel there.
We don't have a hotel, we don't have your views either.
Okay.
But, yeah.
All right, the question is LA has its transit-oriented communities, which you are involved in. Are you involved in that, where you can get a substantial density bonus for residential if you do it on residential zone land or commercial zone land, not on R1? Multifamily zone land, you get a substantial density bonus from the city as a right. Are you doing any of that? Are you looking at projects like that? I think it'll have some meaning going forward if you're not.
Yeah, and I've been looking at it. I've consulted for several groups who are putting those projects forth. Yeah, broadly speaking, it's within a half a mile of transit hubs, and there are different tiers. There's 4 different tiers, and you get graduated requirements on affordability requirements for those, but you get a whole host of benefits, which include parking reduction, increased density, setback variations.
You think
things
it'll
of that
have an
nature.
impact? You think this will have an impact?
Yeah, I mean, the last data point that I read said something in the neighborhood of 5,000 plus units are currently slated to be delivered in proximate to transit-oriented
Are
sites.
you using that on your?
We're not using it on ours because we didn't need it. I mean, we have
Okay.
900,000 feet as of right, and we wanted to just keep it as simple as possible. So we're basically as of right in City of LA, whatever that means,
Yeah,
and our
exactly.
EIR will
Yeah.
still take us close to
Right.
3 years. So we wanted to keep it simple.
Okay. Mary Ann, are you looking
Yeah,
at that?
yeah, we own a property that it's actually in the city of West Hollywood, not in LA, so it's a little different, but still transit-orient development. And the best thing about what the city of West Hollywood is doing with some of these sites is letting you really go through the process, if it's within all the zoning codes, not having to necessarily do an EIR. And so I agree with the last speaker who said CEQA reform is key to what we're doing and to be able to get more housing units, because that's really what kills projects, it just takes too long. It takes at least a couple of years without that, and when you add CEQA on, it's another 2-year process. So it's
How long did it take to get your project going? And
4 years approximately. We had
4 years.
surprisingly a lot of.
That's a short period of time.
Right, it
For-
is.
for
Yeah.
us to-
Surprisingly, we didn't have that much resistance as we had anticipated. We're about 2/3 a mile from the Sepulveda metro line. We got a lot of favor from the municipalities regarding our shuttle service that we're going to implement there for that transit-oriented
So what
worker.
did you have to do for that in that project? Aside from transit, what else are you doing for that? What are you doing?
You know, it's a shuttle that's going to be every half hour to and from the Sepulveda line. Again, 2/3 of a mile from our project. We're doing bike share services that'll come to and from that same node. And then there's a variety of just our walking score that will have parking. We'll give pedestrian parking rights from Sawtelle Japantown, the little enclave of retail village there, of 150 stalls after 6 p.m. on weeknights and all weekends.
To give them parking rights?
To give them parking
And
rights.
how much parking per thousand did you put
So
in?
we were actually the beneficiary of the legacy of that parking garage that's
you
there
can
on
sit-
site, and it's about 5 per thousand usable,
Wow,
which
that's
is great.
Huge.
Other than the fact that they're forcing us to have 4 times as many EV charging stations as LAX
Okay.
to dock us for that benefit. But
You have to bring in extra power for that?
yeah, that's the plan.
Okay, let me ask about SB 50, which temporarily failed, which was basically do away with a lot of single-family zoning, and therefore was very, very controversial. If something like that comes back, does that help a lot or not? If something, SB 50, where you could basically put fourplexes in the Beverly Hills Flats in R1, you could put, under SB 50, in theory, you could put fourplexes in single-family in Santa Monica and Brentwood, you know?
Yeah, I mean, in theory, I think it would. Anything that would increase the supply of housing would be beneficial towards affordability goals. Obviously, as we all know, the homeowners groups in places like Los Angeles have a tremendous amount of power. In fact, site plan review, which is a well-known entitlement requirement for unit counts greater than 50 in Los Angeles, was a partial outcome of the homeowners groups in Westwood, actually, right around 1990. So, you know, in theory, it sounds like a logical construct. In practice, I think it's very difficult, just given the level of NIMBYism and the power of some of these groups. But I think it's fairly well intentioned, and you have to be very measured about it, because there's a reason people paid a lot of money to live in single-family neighborhoods. I think there's a great argument that they have a right to preserve the zoning that they bought into. So we just want to be mindful of kind of creating a confluence of interests that really meshes and is ultimately sustainable and palatable to the voters.
All right, let's talk about another regulatory, did you have a comment?
I was just going to say, that sort of top-down as opposed to bottom-up approach to adding density is just kind of a sledgehammer approach. I know the city of LA's planning department is trying to revisit all its community plans, and with a viewpoint of sort of taking the city's zoning code, which is really post-World War II, everybody, gets a picket fence and a front lawn, and sort of revisiting the zoning code for what's appropriate today. And so I think they're doing a really difficult and interesting job of revisiting the zoning code neighborhood by neighborhood.
But the issue is that 50% of the residential zoning in Los Angeles is single family.
Right. Well, they allowed for the ADUs at least, which
Right.
is a huge deal.
Right.
So
That's a huge- yeah, it's a huge
they're trying to
lot.
address it. Yeah.
Trying to address. The question is Prop 13 amendment is on the ballot next year to split the role between residential and commercial would then in theory be marked would be marked up to market. What's the impact? How much is that going to cost tenants in existing buildings? And then what does that do really? Does that help new construction in a strange way because it becomes a little bit more competitive?
Well, I think depending on the market, it's probably case by case. I think if you're in a rising market like San Francisco, I think you could certainly see full service gross rents going up. But I think if you're in a more of a neutral market or downward, then you're probably going to see the landlord having to take that expense.
Okay, anybody else?
Yeah, I mean, obviously on development, it doesn't have, there's no issue there, but added costs it's going to be difficult. I mean, you have to really look at that for buying existing projects, whether it's retail but at the same time, it's interesting, one thing we didn't talk about on the retail side with all the e-commerce, that the cities are getting really hit on sales tax revenue, right? They're, and if I have a big box and it sits empty, the city's not getting any revenue from sales tax.
But they'll get sales tax from the e-commerce.
They do, and depending on how sort of that works out, it's an issue for them.
But they are when they weren't getting sales tax from e-commerce under the old rules, then it's complete
Right.
loss. The other issue for the city is they lose the property tax.
Right.
Which is not offset, because
Right.
if I buy e-commerce, I pay the sales tax, so the city gets the money, whether I buy it in the store or I buy it from on my computer, the city gets the sales tax. But if the store all of a sudden goes dark, the property tax goes down.
Right, exactly.
Okay. Anybody, you're set? When people look at pro formas and stuff, existing assets, is that are people considering the probability of that changing?
I think they probably will be. I know, for example, a parallel is that in Chicago, where we have a lot of developments,
Yes.
a new county assessor came in, and he was elected under a popular mandate of meaningfully increasing property taxes on all commercial landlords, because it was sort of another kind of a blue populist movement.
Right.
And so right now there's no visibility as to what your property taxes are going to be. Are they going to double? Are they going to more than double? And so what that's done
They're
is...
already high in Chicago.
Yeah. And what that's done is just completely chill the capital markets for real estate in Chicago and in Cook County since November. So like probably capital flows towards real estate there are down 80%, because there's no visibility. You can't underwrite.
And in an office building, what are property taxes like? $12 a foot? It's a big number.
It depends on where. I wouldn't want to just
but it's a very big number.
It's a big number, right.
It's a very big number.
And really the biggest impact is going to be on multifamily.
Yeah.
And so...
So then they'll ask for rent control.
Oh, they don't. There's no rent control in Chicago. No, but
Yeah,
so
that's not
once
gonna
again, it's this sort of,
Yeah, okay.
we talked about it earlier, unintended consequences.
Right.
I mean, we are going to get more tax revenue for the city that needs it. Oh, and now there's no trade, or we're going to put through a rent control provision, which is, if that happened, it would completely, constrain supply, new
Right.
supply, which would cause rents to go up even further over time.
But I want to ask a question to Paul, since you were involved, put on your housing policy hat, which you have in your former life have some experience with. So if you would whisper into Governor Newsom's ear, what would you tell him to help alleviate, to whatever extent, the housing crisis in California?
I mean, look, we've been saying this for years. It starts with CEQA reform. I think that's the elephant in the room. You can only modify it so much. I think exempting housing from CEQA is probably a good start, because that's really where our core crisis resides, at least at the local level. I think if you're looking at local economics, obviously, we have 15 council districts here, so it's very difficult to get consensus. We have these 15 fiefdoms, so it becomes a very kind of decentralized form of government. But aside from that, I think getting rid of some of the perverse taxes on development, like site plan review, I think is a good start, at least exempting by right projects that have certain affordability thresholds resident in those projects would be a good step. Expanding density bonuses, TOCs are obviously a great start, but a potential expansion that's thoughtful and measured would also be beneficial. So those are some places that I would start.
Okay, well, thank the panel. Thank you very much, everybody.